Good morning and welcome to the Financial Shepherd podcast. It's good to be back with everybody again here in Florence, Kentucky at our headquarters. My name is Joshua Casey Garland. I'm the Financial Shepherd and owner of Shepherd Wealth Management. Very excited today. We've been doing on the last couple podcasts a small business segment where essentially I'm having some small business owners come in here, talk about some of the things that got them inspired enough to go ahead and take the risk to move forward with actually starting a business, all the challenges that they overcome to make that happen, and how they intend to continue to grow their business as well as actually put aside away some additional funds for their long-term future retirement goals that they may have and how they go about doing that. So today, I'm very excited to do something a little different. We will definitely continue to do the small business series that we're on right now. But today is going to be more about kind of introducing you to me as a financial advisor and what I do here at Shepherd Wealth Management for clients, and ultimately what my company at Shepherd Wealth Management is here to do for the community as well. So I'm very excited today. So I'm going to start out by just introducing myself. So again, as I mentioned, my name is Joshua Casey Garland. I'm a certified financial planning professional. I started out my career in the field of finance in 2011, but prior to that, I'm actually one of the few people in my family to graduate from college. There aren't a lot of us that went through a 4-year program like I did. There's very few of us that actually completed, a graduate program, as I got my MBA from Ohio University in 2014. So I come from very humble beginnings. A lot of family members of mine are, manufacturer workers, plumbers, electricians, very blue collar sort of family is where I sort of come from here. So the idea of starting a company one day was definitely not in my cards when I first started my journey through college, and I was growing up as a young man, but I couldn't be more excited to be where I am today, and I wouldn't be where I am without some of those humble beginnings. But when I got started in the field of finance in 2011, coming out of college, I got hired by Fidelity Investments in Covington, Kentucky, and in about the first year and a half, while I was in that role, I got licensed, went through a lot of training that they had to offer at Fidelity, which was absolutely phenomenal. And in that first year and a half, I was able to get to the advisor role that I was striving to achieve as soon as I got hired at Fidelity in 2011. In that year and a half, I was able to get the Certified Financial Planning designation, as well as my MBA with a concentration in finance from Ohio University. So I was able to achieve that goal of just getting out of college into the field that I wanted to work in, and within a year and a half, I actually got to the role that I was looking for, which was a financial consultant role at Fidelity Investments, which at that time in the Covington call center that they have here in Kentucky, no one has ever done that in that short of a span of time. So I was very, very, humbled and honored to be able to make that happen for myself and my family. And throughout that, journey of getting to that role, received a lot of accolades and rewards and recognition for the performance I was able to produce for my clients. And certainly really benefited from that, not just financially, but also from a career path perspective. And in 2014, I decided to get out of the call center and move to TD Ameritrade, where I continued to work as a financial consultant out of the Cincinnati office. Spent about 5 years working there, received a lot of accolades again, got to go see other parts of the world I'd never been to, such as Cabo and Jamaica, and eventually took over the TD Ameritrade Louisville office in 2018, which was a $1.3 billion branch as far as the size of the number of client assets that they had there. And it was a great opportunity for me to go from just being a financial advisor to not only being an advisor for clients in the Louisville market, but also to lead a group of other advisors and actually manage a very large branch. And we were, at that time, a bottom 5% producer out of about 265 branches that TD Ameritrade have of equivalent size. We were right around the bottom of that. I think we were right about 260 out of 265. And within the first year, we were able to achieve a lot of growth and success, and we're actually a top 5 producing branch there at TD Ameritrade out of the Louisville office. So how do we make that happen? And we did that by doing the exact same thing that I do for my clients here at Shepherd Wealth Management. So a lot of investors, and the main reason why I love the field that I work in here as a financial professional, a big reason why I wanted to start Shepherd Wealth Management is because I noticed over about a 9-10 year span of time of working with hundreds of clients throughout all 50 states, I've learned that a lot of investors know that they need to participate in the market. They have long-term goals. They have some short-term and intermediate goals. In order to accomplish those goals, they know that they need to save money. They know they need to invest that money. And they know that it's probably going to take, a fair amount of years for them to ultimately get to where they want to be from a financial perspective. Unfortunately, most of those same investors didn't have any idea on how to accomplish that goal. They didn't have a strategy to make that happen consistently for them. So what that often produces is a lot of fear and anxiety, which, as we've talked about throughout the last couple of podcasts and also on my book club, is that the number one issue that most investors have in order to accomplish their objective, short, intermediate, and long term, is themselves. Because we're all human beings, we all get anxious and nervous and fear things that we don't fully understand. So a lot of investors just simply felt like, yeah, I need to participate in the market, but I don't really feel like I have any control over the performance of my portfolio, and I really don't feel like I have a way to manage the risk of being able to achieve those short, intermediate, and long-term objectives. So how we were able to solve that while I was working at Fidelity and at TD Ameritrade, and now here as the owner of Shepherd Wealth Management, is a strategy that's actually been around since 1952, known as modern portfolio theory. So first of all, what is modern portfolio theory? So a professor named Mr. Harry Markowitz, back in 1952, introduced this idea of modern portfolio theory. And basically what he was able to prove is that over long periods of time, and long periods of time being, at least a market cycle, which is approximately 5.5, 6 years. To me, a long period of time would be closer to 10 years. But over a long period of time, if you can control your asset allocation, which is just a fancy way of saying this is how much of your money is invested in stocks, bonds, and cash, if you can control that, which, by the way, to all the people watching and listening to this, there's all kinds of stuff that you'll never be able to control when it comes to making investment decisions. You can't control, the interest rate environment, how the Federal Reserve makes decisions. You can't control, some labor shortages that we may have, who's president, and on and on. We can talk about all the things you can't control, for the next hour and a half if we wanted to. But the one thing that you're always in control over is your asset allocation, that percentage of your money invested in stocks, bonds, and cash. And if you can control that, Mr. Markowitz was able to prove with his theory of modern portfolio theory that if you can control the allocation, your results are very predictable from a performance standpoint over time. And it actually helps you control the risk that you take as you go to make your long-term investment decisions. So a recent example of that, if we go back from 2000 all the way through 2019, so the last 20 years worth of market information, and we're talking very broad-based indices here that you could participate in, that you can actually put your money to work in, such as small cap stocks, large cap stocks, international stocks, long-term government bonds, and of course treasury bills, which would be very much a cash equivalent. So those are 5 very broad-based indices in which investors can allocate capital to and participate in to help them achieve their long-term goals of growth. The problem is, if you look at the actual performance for all 5 of those asset classes over the last 20 years, there's no predictable pattern to their performance. Some years, long-term government bonds outperform international stocks, large caps, and small caps, like a year like 2008. And certainly some years, international stocks outperform the U.S. market as well. So there's really no pattern that investors can follow just by looking at the performance of those asset classes from the prior year, which is a huge mistake that I see a lot of investors make as they go about building their portfolio or their asset allocation. Oftentimes I ask them, well, how did this 401k that you got invested actually get set up the way that it did? How did you actually have these positions in your account? Or how did you actually make the decisions that you made when you built your IRA positions? And most of the time investors tell me that they're looking at the prior year's performance. So I was looking for the mutual funds or the ETFs or the stocks that had, the best performance in their sector the prior year. And oftentimes, that is a big error that you'll tend to fall into if you're strictly just looking at performance of an asset class from the prior year and expecting that to continue the very next year. And over a short period of time, as I've mentioned before on a lot of podcasts, is that the stock market is a terrible place to invest short term because we have no idea what the performance will be in any one of these asset classes over a very short period of time. But over a long period of time, like we talked about with modern portfolio theory, if you can control that asset allocation, your performance and risk is very much defined and predictable. So getting back to this example here from 2000 to 2019 for these 5 different asset classes, there's no actual pattern to the way that they perform. However, as a simple example, if we just took those 5 different broad asset classes and decided to allocate the exact same percentage to each one, in other words, we put 20% in small cap stocks, 20% in large caps, 20% international, 20% long-term government bonds, and 20% in T-bills, as long as we controlled that mix of 20% in each one of those asset classes, meaning that we rebalanced the portfolio to keep the percentages exactly the same. So in other words, we controlled the one thing that we can control, which is our asset allocation. The results are very much predictable. There is a pattern. You're not going to outperform the broad market by holding 5 different asset classes on a consistent basis, but you're certainly not going to dramatically underperform the market either. So the performance over that period of time was very predictable. And if we actually look at 3 specific periods of time, over that 20 years, starting with January of 2008 through the bottom of the market crash, which was right around February of 2009, an all cash portfolio was really the only thing that was positive, other than maybe some long-term government bonds. But an all cash portfolio was up about 1.6%. An all stock-based portfolio, which in this example would be defined as 70% allocated towards the United States stock market and 30% international, you would be down almost 50%, which is the worst correction that's happened since 1929. So from 1929 to 2008, those are the 2 worst corrections. Statistically speaking, if you're a long-term investor, it's unlikely that you would experience another year as dramatic as 2008, but certainly would be your worst case scenario for most investors. Now, this diversified portfolio, and to be fair, since we're thinking long-term and we're probably more growth-oriented, that asset allocation will come out to be about 70% U.S. stocks and 25% in bonds and about 5% in short-term. So your performance during January of 2008 through February of 2009, that big correction that we all know happened in the real estate market that affected the whole world, and specifically here in the United States, that portfolio would have been down by 35%. Now, in other words, you did beat the market. Since the overall stock market was down about 50%, you did outperform, but nobody's going to feel good, looking at their portfolio at the end of the year, seeing that they're down about 35%. Now, however, when we get to the next period of time, which is the recovery, and I'm going to shorten the recovery because the recovery actually lasted longer than this, but let's just look at the recovery from March 2009 to February of 2014. All cash portfolio definitely did not even keep up with inflation, and inflation was very, relatively low during that period of time, but the all cash portfolio was only positive about 0.3%. The all stock portfolio, which again, 70% U.S. exposure, 30% international, that was positive 162.3%, which sounds great. But remember, the prior year, you lost half your money. So in order to get back to even, you have to get at least 100% return. So 162 is not bad, but you had a big hole to dig yourself out of after 2008. This diversified portfolio, which is again about 50% U.S. stocks, about 20% international, 25% fixed income, and 5% in short-term or cash equivalents. In March 2009 to February 14, you had a positive return of almost 100%. So you had a much smaller hole to dig yourself out of, which gave you the opportunity to start seeing gains a little bit faster. Now, when we blend both of those periods of time together, which would be the bottom of 2008, all the way through February of 2014, an all-cash portfolio maybe broke even with inflation at a 2% positive return. That all-stock portfolio was positive 31.8%. It's not too bad. But this diversified portfolio is positive 30%. So there's almost the exact same performance as the overall broader U.S. and international stock market produced. However, that investor with this diversified portfolio over this period of time had about 25 to 30% less risk than the all-stock portfolio investor had. So you were able to achieve almost the exact same return with a substantially amount of less risk. And the great news is if you do know the types of results that you're looking for, whether it's short, intermediate, or definitely long-term, if I'm looking at my situation and thinking to myself, you know what, I would be very happy if I could consistently achieve an 8% average return out of my portfolio. I feel like I could get to where I want to go over my 10, 15, 20, 30 plus year period of time. I'd be satisfied with that. Well, the great news is you don't have to reinvent the wheel. There are a whole bunch of different asset allocations, and I typically show my clients about 9 different asset allocations. And if you go back from January of 1926 all the way through December of 2015, it's a very large sample size here. Your cash-based portfolio tends to average right around 3%. Whereas somebody that's very aggressive and wants to have the majority of their money in the stock market is going to average right around 10% and everything else in between. So if you're thinking to yourself, you know what, I'd be very happy if I could consistently achieve an 8% average return, well, I can make an argument to you that if you do, in fact, have the time to think long-term and you are a long-term growth investor, you can have about 50% of your portfolio in equities and about 50% of your portfolio in cash and cash equivalents and fixed income, and you would expect to average right around that 8% return. So you can achieve the results that you're looking for with about half of the risk of the market. And by the way, the market over a long period of time, meaning 10 years or greater, the S&P 500 tends to average right about 10%. So being able to capture, let's say, 80% of the entire stock market's growth and taking 50% approximately less risk than the overall market, that's a pretty good outcome, in my opinion. I think most investors would agree with that. I know that a lot of my clients that are retired or very close to retirement are very comfortable with that. But the important thing is that you need to know the types of growth that you need to achieve the results you're looking for, but you also need to understand and have a game plan or a strategy in order to accomplish that goal. And I think every investor is looking for a way to achieve the goal that they have for themselves so they can have their own personal financial peace of mind in place, and doing that with as little risk as possible along the way. So that is modern portfolio theory in a nutshell. That's the strategy that we use here at Shepherd Wealth Management. It's the exact same sort of strategy that we used at Fidelity Investments and at TD Ameritrade. You'll find a very similar strategy at most of the large institutions that you know, such as Charles Schwab, and even some of the robo-advisors are using modern portfolio theory. They're just using it a little differently than what we would do here at Shepherd Wealth Management. Now, modern portfolio theory is a great strategy. It's something I believe in to my core because it helps clients get control over the one thing that they feel like they have no control of, which is the risk to achieve the performance that they're striving to get accomplished for themselves. The way that I take modern portfolio theory to a different level is not just using these broad-based indices. So we've been talking about how investors can build an asset allocation using broad-based indices such as, your indexed ETFs or mutual funds in large caps, small caps, international, fixed income, et cetera. What we do, once we've identified the right type of mix of stocks, bonds, and cash for an individual investor based on their goals and what they deem to be important to them, for the U.S. part of the asset allocation, we're going to use individual stocks here. And that's an important distinction to talk about between the roles that I had at Fidelity and TD Ameritrade, I think, because at Fidelity and TD Ameritrade, they're very large institutions, very well-known and reputable. I have nothing bad to say about my experience working in that industry. I wouldn't be in the position that I am today with the clients that I have had I not went through that sort of, experience, if you will. But if you think about it like this, when I was working in the TD Ameritrade Cincinnati office, there was about 6 different advisors. All of us at one point in time were all certified financial planning professionals. And we all used modern portfolio theory. That is exactly what the strategy that TD Ameritrade believed in and still does to this day. But we didn't get to build the portfolio any way that we wanted to. And what I mean by that, once we picked an allocation, let's just say it's 50% stocks and 50% fixed income, I couldn't, and neither could any of my coworkers at TD Ameritrade, just go ahead and pick whatever, ETFs or funds or individual stocks that we wanted to for a client. The reason for that is this, as a simple example. Let's say that I'm sitting down with you and we've identified that 50% stocks and 50% fixed income is the right asset allocation for you. And my coworker, sitting right next door to my office, has a very similar client, very similar circumstances, similar age, similar risk tolerance, and they're also going to use 50% stock and 50% fixed income. Well, if we could just both build the portfolio however we wanted to, and let's say my client's results were great, and my coworker's client's results were terrible, even though they're very similar clients and using the exact same sort of strategy, that opens up the company, in this case TD Ameritrade in this example, to a lot of risk, right? The individual advisor risk is the way that they would look at that. So in order to reduce that risk or eliminate it, they were just saying, hey, these are the model portfolios for a 50-50 client, and these are the ETFs that we think are the best fit for that particular client. So there really wasn't any customization, if you will, very little for any of the clients that we had at Fidelity or TD Ameritrade. And that's not a bad thing. Those clients still were able to achieve, in this example, a 50-50, about that 8% average return over a long period of time. And some years were much better than that. Some years maybe not as good, but over a long period of time, that is exactly the sort of result that they were able to achieve. The way that I do that a little differently here at Shepherd Wealth Management for my clients is that for the U.S. part of the allocation, and again, if we just stick with this simple example of 50% stock exposure and 50% fixed income, well, of that 50% that's going to be in stocks, maybe 40% of it's going to be allocated to the United States. So in order to fill in that 40% of U.S. exposure, we're looking for leadership stocks. And what I define as a leadership stock are what the same way that Warren Buffett would define it, which would be a large, prominent, conservatively financed entities or companies with a big moat of safety is another phrase that Warren Buffett would have. So what does it actually mean? Well, if you actually look at the S&P 500, which is around 500 stocks, it might be a little bit more than that these days. I think it's about 505 actually. But the top 25 stocks based on market cap weighting, that represents 40% of the entire United States stock market index. So just 25 names of about 500 total possible names that represents United States stock market. Those top 25 move the whole index by about 40% at any one given point in time. So these companies definitely are large and prominent. The question is whether or not they're conservatively financed and is their management quality as good or better than all of their peers. So to me, leadership stocks would be those large companies. And in this example, we can just look at the top 25 of the entire S&P. Now, it would be kind of foolish just to say, okay, I'm going to own all 25 of these large companies as part of my U.S. exposure as an individual investor using this concept of modern portfolio theory. But it's a good place to start to do your research. You can say, okay, I'm going to look at these top 25 companies, and I'm going to go look at them one at a time, starting with Apple, which is the largest from a market cap weighting, and I'm going to compare Apple to all of their peers. And then once I look at all those financial ratios, PE ratio, the PEG ratio, the quick ratio, all these different fundamental analysis tools that we have and easily accessible information to find anytime you pull up any of these companies, we can begin to compare them over long periods of time to all the competitors in that space. And if we can say, okay, they're not only large, prominent, they're conservatively financed, and when we do research on the management company, specifically the CEO, we can begin to make some decisions on which one of those positions might be the best fit for that part of your portfolio. So for my clients, the total asset allocation is going to have about 20 different positions, but about 15 to 16 of those positions are going to be in U.S. individual equities, if there is in fact going to be any equity exposure at all. Now, of course, some clients don't want stock exposure because they don't necessarily need it. They just want to preserve their wealth that they have, and they might have little to no stock exposure. But for those that are looking for growth, they certainly will need some stock exposure, and that's a great place to start. And what that does is it optimizes the portfolio. So there's a lot of academic research that supports this idea. And actually going back to Warren Buffett's role model and professor when it comes to things like building a portfolio, making investment decisions was Ben Graham. He wrote a famous book that probably most of you have at least heard of called The Intelligent Investor. By the way, anybody that's interested in doing anything along the lines of financial planning, I think that's a great place to start to begin to get a real in-depth look on how these classic fundamental investors like Warren Buffett, Ben Graham, Peter Lynch make those types of decisions. They all reference a lot of the learnings that they took away from the Intelligent Investor book. But by doing it that way and only owning 20 positions, that optimizes the portfolio. There's a ton of academic research that would support that and saying that about 20 to 30 positions would provide an individual investor the same sort of risk characteristics as the overall market, but would give you the opportunity to certainly perform a little bit better than that depending on how you weighted those positions in the portfolio. There's this concept known as over-diversification, which is another big risk, and that might sound a little weird to those watching or listening to this, that over-diversification is a risk to them. Well, what does that mean? Well, if you actually own a whole bunch of mutual funds or a whole bunch of ETFs or a whole bunch of individual stock and bond positions, once you exceed that threshold of about 20 to 30 positions, you're not actually helping yourself or protecting yourself if the market goes down from a downside risk perspective. But you definitely are limiting the upside opportunity for growth. So by using some of these individual stock names, so in my client's case, it's going to be about 20 total positions. And of those 20 total positions that fill in the asset allocation, about 15 or 16 of them will be individual equities. So by doing it that way, as opposed to owning all 500 companies through the SPY, which is the S&P 500 ETF index that tracks the SPY and the entire U.S. stock market, by owning just a few of those companies, it gives you the opportunity to outperform the broader market for that part of your asset allocation. And in doing so, it certainly gives me the opportunity to differentiate myself from what I do for my clients here at Shepherd Wealth Management versus what you would experience, working with an advisor through a company like TD Ameritrade, Fidelity, Edward Jones, JP Morgan Chase, et cetera. All of these companies that definitely utilize modern portfolio theory. They just do it a little differently than we do it here at Shepherd Wealth Management. So that's the strategy that we utilize to solve the big problem that most investors have, is that I don't feel like I have a way to control the risk and the upside performance of my account. I just know I need to put money in the market. So I'm going to go ahead and set it up and put a certain amount of money into my position and just forget about it. That's typically the way that most people would approach that. And I would argue that there is, in fact, a way for you to get the results you're looking for, probably with a lot less risk, with just doing a little bit of homework, or by working with somebody like myself. You can certainly control that asset allocation, achieve the results that you're looking for, and have a lot of fun doing it if this is something that you truly enjoy spending some time on. If not, at least you know where to turn to, and I can certainly help you out with that. Now, part of what we do here at Shepherd Wealth Management definitely revolves around three key pillars, and we've touched on this in some of the podcasts that we've done with other business owners here. And that performance, purpose, and passion are really the three key pillars that we built this company around, and I've built my life around, and try to build this business of mine around. And performance is obviously first and foremost what's going to be top of mind for pretty much all my clients, and for anybody that's investing at all. Performance is certainly important to you, but being able to identify the type of performance that you need to achieve consistently is definitely going to be very key. And in order to achieve that performance, we need to control the risk and give ourselves the highest probability of achieving that result over time with, again, as little risk as possible. So as we talked about before, there's all kinds of things you're never going to be able to control when it comes to investing your money. All kinds of different issues are going to come up in life. They're going to take your time, energy, and attention away to being able to do the research that you need to be able to do to make informed investing decisions as market conditions change. So with all these different variables that are going on that can potentially be hurdles or obstacles that would prevent you from achieving the results you're looking for and getting that performance, we believe that we can help you achieve that result very consistently using the strategy that I just laid out. And it's not just about achieving, the types of results consistently for our clients. We would not only want to be able to make money for you, not just because we want to make money. Of course, that's, important to all parties involved here, for my clients and myself, but it's also using that money to do something that is going to make an impact in the world. One of my goals personally is to be able to leave, a footprint or make an impact in a way, and leaving this world a little bit better off than what it was prior to me entering it. So we're very purpose driven, meaning that every quarter when we sit down with our clients and have a quarterly review, so what that quarterly review might look like is, if you're looking for that 8% average return, well, during that quarter, we're either going to be on pace, ahead of pace, or behind pace to help you achieve that. So we're going to talk about why we are where we are, what changes we might suggest making, but also we're going to take the first 10% of the revenue that we generate during that quarter and use that money to invest in local community charitable organizations. Not going to any specific church organization, or not going to any sort of government or political organization, but to organizations that are important to not only me, but also my clients. So during that quarterly review process, I'll take a list of all the important charitable organizations here locally and around the world that are important to my clients. And once a quarter, we'll pick one of those organizations to make that donation to, and we'll highlight that and celebrate that during that quarterly discussion. So it's not just about driving performance. We want to do something great with the growth that we're seeing, and we're passionate about doing that. So the two main passions that I have in life is performance, because that's how I can take care of my clients. That's how I take care of my family and make sure that my kids have shoes and clothes and go in the school they want to and dinner on the table, of course. But we are definitely purpose-driven as well. So those are the two passions of mine, is producing for you and actually doing something good with that. I don't know anybody else in my space doing what I do as a certified financial planning professional, where the top line revenue on their income statement is immediately followed by 10% of that revenue number going to a charitable organization. I don't know anybody else doing that in this space. Obviously, that's something that differentiates myself and my company from pretty much all the competitors I have in this space. I don't know a lot of individual certified financial planning professionals doing what I do, running a registered investment advisory firm and working with individual clients, that has a podcast, that's sitting here, making these types of investments and having these discussions with the public on an ongoing basis. Now, what I want to transition to here for the next maybe about 5 to 7 minutes as we kind of wrap up today's podcast, which I've had a ton of fun kind of sharing with you my experience, my background, what I've done for clients and how we go about solving some of their biggest problems. I want to take some questions, or at least introduce some questions that some of my clients have recently asked me, and I want to share that with you and some of my thoughts about these questions. So Dan in Cincinnati asked recently, how would the Fed's tapering decision affect the stock market? And when should we expect this to happen, or when would we expect the tapering decision to actually happen? Well, obviously, this is a great question, Dan. This is what's on TV all day long. It's what's the headlines in the Barron's articles and Wall Street journals, is how is the Fed going to go about addressing their $120 billion per month bond purchasing that they're doing right now. So when is that going to begin to slow down is essentially what the question is here, and how would that affect the market? Well, I think the Fed's already kind of hinted at the fact that it's potentially imminent that tapering will happen maybe in the end of 2021, maybe as soon as the end of September or beginning to get into November, when the Fed actually meets again after their September meeting. But I think a lot of that's going to actually have to do with the data that they're seeing. So you're going to see a jobs report come out on Friday, and I think the jobs report is probably going to be modest, maybe a modest decrease in the unemployment rate. We'll find out for sure when the announcement actually happens on Friday. And the reason why I think that's probably the case is because we're still seeing a lot of stimulus checks due to COVID that are going to be received by individuals across the country to about the middle of September. And then once that stops, of course, people will kind of be forced to find employment. And that's another topic of discussion that the Fed's highly interested in looking at, is how are we going to get these folks back to work? And if we do get them back to work, that should help us reduce inflation, which will allow the Fed to not have to necessarily increase short-term rates. The Fed Chairman Jerome Powell already announced in his most recent Jackson Hole Summit meeting to the world that even though the Fed may begin tapering sometime in 2021, that does not mean that they're going to increase short-term rates in the short term. So to your question here, Dan, how is that going to affect the market? Well, corporate earnings are really what matters the most as far as the stock market growth is concerned. And more importantly than that, are corporate earnings good, and do we expect them to continue to go higher and sustain that? But we also have to look at the interest rate environment, because if interest rates remain historically low, that it makes it very profitable for organizations to borrow money at a very low rate and make investments into R&D and human capital and their future expansions. So because of the fact that we're still going to have low interest rates, even if the Fed does decide to taper here in 2021 before the end of the year, corporate earnings have been nothing but phenomenal. Record earnings across the board for pretty much all sectors. That gives us a great environment to continue to see the stock market to grow, not only through the rest of this year, but into 2022 as well. So as far as the timing of when that will happen, I think more data to come here, but I would expect potentially the tapering to happen late in 2021 or early 2022, kind of depending on what the job outcome looks like and how that has an impact on inflation. So another question we have here from Louisville, Jerry asked, I'm a growth investor. I don't need any funds in my account. I have a very long time horizon, even though I'm retired. My family tends to live a long time. Do I actually need to have bond holdings in my portfolio? So this is a very common question I get from a lot of individual investors that are in your shoes here, Jerry, where the main goal for growing their money at this point in time in their life, being retired, is to leave a nice inheritance or a legacy to their heirs. And that's exactly where Jerry lies here. So to answer your question, Jerry, do I need to have bond holdings in my portfolio? Well, the answer is yes. The question is just how much do you need to have? And the reason why I say that the answer is yes is because inevitably, even though the stock market over a long period of time, over the last 100 years, is positive about 70% of the time, it also means it's going to be down about 30% of the time. And you want those down periods to happen so you can take advantage of, buying opportunities, specifically, if you're a long-term investor with a goal of growth and leaving a nice legacy to your heirs. And how you handle that is just what we talked about earlier with modern portfolio theory as the strategy to control the risk of the market when it does go down, but also give yourself the opportunity to benefit from that. So if you have, let's say, 80% of your portfolio in equities and 20% in fixed income holdings, well, great. As the market moves up, you're going to participate in a lot of that growth with your equity exposure. But if the market does go down for a short period of time, it allows you to liquidate some of those short-term fixed income holdings in the account and use that capital to now go invest it into stocks that are now on sale, so to speak, after they've had their pullback. And as soon as you do that, give it a little time, you'll be very happy that you made that decision as the market continues to recover, which it always has, and we would expect to do so. And when you get that growth out of your equity portfolio, you'll do the exact opposite. And that's the hard part, is the discipline after you've seen a lot of growth and after you've had a lot of success in the positions in your portfolio to periodically go in there and sell portions of those gains and use that capital to reallocate it towards your fixed income holdings to protect that gain. And you'll rinse and repeat as the market goes through its normal cycles. So it's a great question, Jerry. I certainly hope that helps you out there. And last, from Florida, Katie wants to know, is now a time to consider adding auto stocks to my portfolio? So this is an interesting question. And it's interesting because there's a ton of demand for vehicles. I think we all know that right now. Vehicle sales are absolutely fantastic, but there's a big issue here with chips. There's a shortage of chips, and we need those chips to be able to make the vehicles that power the computers and all those different things for your SUVs, cars, and trucks. So I think, to answer your question, Katie, and I think Charles Schwab would definitely sort of back me up on this. So I do a lot of my research through Charles Schwab's platform because that's who I custody my clients' accounts at Shepherd Wealth Management, is through Charles Schwab. And I do think they have pretty good research tools here. So their opinion on it is exactly the same as mine, in that there is a lot of value because those positions in General Motors and Ford, even though their earnings have been good this year, have actually underperformed the broader market and have very low price to earnings ratios relative to their peers in their industry, and certainly very low relative to a lot of other sectors of the market. And the demand for vehicles is very high, but the fact of the matter is there's a chip shortage here, and it's kind of hampering the ability for these companies like General Motors and Ford to meet that demand and produce the types of cars fast enough to hit the demand, which is why you're seeing prices for vehicles, both used and new, go up. So there is a lot of value in some of those securities. My concern is when are we going to get the chip shortage to no longer be an issue? And if that chip shortage takes longer than expected to actually be able to meet some of the demand for car sales, well, what's the rate environment going to look like at that time? Right? What are some of the decisions that the Fed will make regarding interest rates that could potentially hamper a cyclical stock or a cyclical industry like the auto industry? And in addition to that, we don't really know how these potential tax law changes that are coming up and being discussed regularly right now can not only affect individual investors, but also corporations as well. So I would say that there's potential value, and if you are a long-term buy and hold sort of investor, it could be an opportunity for you to slowly add those positions into your portfolio. But just keep in mind that there's a lot of potential issues and hurdles that industry is going to have to overcome to see the type of growth that you might find in other asset classes. So for me, I could definitely find other ways to generate a lot of growth for clients outside of the auto space. But if you are going to allocate some capital to it, I would just tell you to do it with caution, maybe slowly add little pieces of that to your portfolio because there certainly is some value to be held there. But it is definitely going to be, in my opinion, a long-term view that you'll need to have for that specific sector of the market. And remember, it is a cyclical, so it tends to do very well as the economy is growing and tends to struggle quite a bit as the economy is declining. So those are some questions that I've received recently from clients. These are all great questions. I'm sure they're on the top of your mind as you're watching and listening to this. It's been an absolute pleasure to be able to formally introduce myself through this podcast to everyone watching and listening, and talk about not only the problems that I can help you solve with your portfolio, but also the things that are important to us here at Shepherd Wealth Management, and providing a lot of good things here to the local community. So if you have questions, any comments, topics that you want to talk about, questions that you have, give me a call, send me a text. My number is 513-630-2664. The email address for me is jcgarland@shepherdwm.com. Follow me on Facebook, Instagram, and Twitter. And don't forget to check out the podcast on YouTube and Spotify. There are links to both the YouTube channel and the Spotify platform on my website, which is shepherdwm.com. And lastly, don't forget to check out our Facebook book club. The book club is called the Financial Shepherd Book Club. And we'll be finishing the book One Up on Wall Street by Peter Lynch tomorrow, which is Wednesday, November 2nd at 5 p.m. Eastern Standard Time. We're actually going to announce the new book that we're going to cover in September, and we're also going to have a new day and time, which the book club will actually get started, which will happen on Tuesdays at 5, starting on September 7th. And we'll reveal all of that in more detail tomorrow. So it's been great. Hope you all have a great rest of your day. And we'll look forward to doing this again in about another week. Take care.